All right. Good morning, everyone. Welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. live. Happy to be back. Tim, how you doing this morning, man?
Not too bad. Just moving along.
Yeah. So this week we're going to do a little bit of a different show. The last couple of weeks we've been talking about investor sentiment and what the Fed rate is going to do, and multifamily operations, and just a lot of the hardships and things that we've been going through and have come to a different understanding of, and just wanted to parlay the message and keep you guys apprised of what's going on in the day-to-day life of a multifamily operator and syndicator. And so we thought we'd do a little bit of a pivot here because it kind of felt like we were beating a dead horse with the subject titles and stuff. So this time we wanted to talk about why we think it's a better time to get started in multifamily now than ever before. It's no secret. Everyone knows, from 2018, 2019-ish until about 2022, there was just this absolute hockey stick growth of multifamily deals and syndicators on the rise. And everybody was making money in real estate in the late 20, how do you say that? The late 20 teens, early 2020s?
Yeah, really just the late teens and early 20s, I guess.
Late teens and early 20s. Everybody was making money in real estate. So now what you're starting to see is there's been a lot of stress and a lot of pressure in the market because cap rates have decompressed. NOI has been compressed with increased insurance costs. Tax reevaluations have come through. A lot of cities and states are on like a 5 or 7 year reassessment schedule. South Carolina, for example, is on a point of sale schedule, so it's a little different in South Carolina. But states like North Carolina, they're generally on a 5-year schedule. So you're starting to see a lot of those tax reassessments hit and NOI be further compressed. And that's exactly why we were going to talk about why getting started now in multifamily versus getting started in the last 4 to 5 years is an ideal time, an opportune time for you to get started, because the prices have been readjusted for, I guess, 2025 and beyond. The prices have been readjusted for the increased cost, right? So increased tax, insurance, payroll, utilities, decompressed cap rates, all of that has been priced in. So what you're able to buy now is going to significantly set you up for better success in the next 5 to 10 years. Because if you think about how stock investing, everyone talks about, buy on the dip, right? This is the dip in the multifamily world. And, it's not really felt too much on the single family side of the real estate world, but it's definitely very, very, very heavy in the commercial real estate side of the world. And that's because it's not as publicized as single family housing news is. So, that's my opinion on why we think you should get started in multifamily now more than ever before. Tim, how do you feel about, or do you have anything to add to that?
No, I mean, I've been saying that for a while, that this is the time to buy. Because we're hearing from a lot of our friends and our network that, they're having a lot of trouble raising capital, that a lot of investors are sitting on the sidelines right now, just kind of saying, not right now, not right now. And I get the sentiment, for a couple of reasons. Like we've been talking about the zombie deals for a while. We've been talking about the other operators and stuff who are, really, really struggling. You're seeing a lot of like bad news, but guys, like, honestly, like a part of the reason you're seeing a lot of that bad news is because the guys that were buying so heavily in 20 and 21 and 22, especially, those things aren't working out, right? It was the height of the market. Things were hot as hell. It's like, speaking of the single family space, which people can more relate to, you'd put your house on the market on Friday and you'd have 15 offers by Sunday morning. I mean, the commercial real estate space was kind of the same way.
Mm-hmm.
If you didn't come in with the highest offer, you probably didn't get it. And then if you didn't close within 60 days, like your contract said, you probably lost your earnest money and they went and got the next guy who had the highest offer. So it just created a market where people were paying, $200 a door for things that really should have gone for $150, for example.
The FOMO was the biggest thing,
Yeah.
in especially in 2021 and 2022, there was this FOMO
Yeah.
that was setting in. And it was like, man, the real estate market had been so hot for so long. If I don't get into something, I'm never going to make money.
You know what was interesting at the time is, um, and I kind of had this feeling too. I was like, hey, I really want to get something going. I want to do something. Um, and fortunately for us, most of the stuff we bought, we did get at a good basis. Um, but I saw a lot of guys getting out there, and they were like, I want to do a deal. I want to do a deal. And because of that FOMO, right? They were like going hard after deals. They were overpaying for deals. They were stretching on things. The interesting thing was the guys that had been in the game for a while, who had a portfolio that paid them every month, and they were pretty comfortable. I like to call it belly is full, right?
Mm-hmm.
They've eaten and their belly's pretty full. They were really patient. So over that stretch, like a lot of those guys, like maybe bought a deal, maybe bought two deals. They were just sitting there, right? They were just kind of like, I'm not doing it right now. And I don't need to do it right now. So they didn't really have that FOMO going on. And now I'm seeing some of those guys like really step back into the game.
Mm-hmm.
They're like, this is when I double my portfolio. This is when I triple my portfolio.
Right.
So I'm seeing some of that now with some of the guys for sure. Um, the one thing I will say though is I don't think seller expectations have quite adjusted as much as they need to. Um,
Oh, no, absolutely
no,
not.
yeah, there's still some guys out there. Like, I mean, Tim, I saw it come through my email today. A deal that Tim and I got presented off market like 60 days ago. Um, it came in through Crexy today, which is no longer off market. So, and Tim and I saw it at the time. We were like, that's just asinine. I can't believe they're asking that price. Well, apparently a lot of other people felt the same way because it's now out there on Crexy at the same price. And my guess is it'll sit there for 300 days.
Yeah.
And and this time next year we'll be like, hey, I'll make you an offer if you're, if you're still interested.
If you still want to have a conversation, a realistic conversation.
Yeah, but you're seeing a lot of that, right?
Yeah.
And seller expectations are adjusting some. I don't think they're adjusting fast enough.
Yeah. Morning, Dennis.
What's going on, man?
I'll put this. I like this little button here. It shows the comments on stage as they come up, so I don't have to like click on
Yeah.
them. Yeah, man. So Tim, here's an interesting question. We've been doing this since, I mean, you've been doing it a lot longer than I have, but I got it started in 2019. It's 2025, 6 years later for me, like what, 10 years later for you. If you had to start all over again, what would you do first? Now looking in hindsight of like all the things that you've done, all the things that are bearing fruit today, all the seeds that you've sown over a long period of time, where would you start first next time if you had to do it all over again?
Sorry, let me ask a clarifying question here.
Okay,
So
ChatGPT.
yeah, so thanks for the 10-year thing. So I started doing the land stuff in '06. So are you
Oh
asking me
yeah.
if I would? Are you asking me if I would do land different, or are
No,
you
no, no.
asking
In the
me?
multifamily space,
Mm,
from what we've been doing in the multifamily space, where would you start over again?
Um, I'll answer that one this way because I'm on the road quite a bit. So what I would say is that I would have stuck to my guns a little harder about staying in the Carolinas. Um,
Mm,
I would not have expanded outside the Carolinas, um, simply because um, the operational piece is very difficult when you're running your own property management company, running across different markets like that. And then the second piece is that the employee base very much varies state by state. Um,
hmm.
so I think that would probably be the one thing. And now I'll say this, guys, like that's coming from somebody who today knows that they're going to own a property management company. I didn't know I was going to do a property management company 10 years ago. Um, so that's probably where I would go today, knowing if everything had worked out the same.
Yeah, just a tighter radius. Even so,
Greater
even more
radius.
so than just in the
Yeah.
Carolinas. I mean, because even what I think, even what we've found is even buying in the Carolinas, you can still be in the Carolinas and be difficult to get to, right?
Yeah.
Because the Carolinas are a very big geographical area, and it can
Right.
take a very long time. That can be difficult to manage just because the proximity to other assets. Some of the guys that I think are incredibly successful have really been able to buy a large or medium-sized portfolio in a single location, right? So Brandon is one guy that comes to mind, and he's got all of his assets like within half an hour or 45 minutes from each other. So he runs all of his expenses through his management company, and then allocates the payroll down to the different properties. And he can send, and the maintenance guy doesn't work for one property. He hires specialists, right? So he has one guy that's great at HVAC, one guy that's great at plumbing, one guy that's great at electrician, and he just sends them all equally to wherever they're needed to work on their specialized tasks, unless it's just like kind of general maintenance type of
Yeah.
stuff. So he's been able to get better economies of scale and cost because he's got one guy that can replace all of his HVAC. Maybe he's got two guys now, but two guys that can replace all of his HVACs, and he can be at any one of his properties, all of them in a single day if he really needed to.
Yeah.
So I think if I had to go back on that same sentiment, I would probably focus harder on a market like Charlotte, Raleigh, Columbia, one of those major metros that has a lot of opportunity in it. But the difficulty of it when we got started was the cap rates were so compressed, nothing seemed to make sense. And that's why a lot of the guys now that were paying 200 plus a door are getting crushed because they wanted to get into the game and just doing whatever they needed to get into the game. And now it's biting them in the ass hard.
Yeah. Yeah. I think the one edit I would have to that is, um, I'm kicking myself because there's two markets that we own in right now that like 4 years ago, I was like, I think those are going to be good markets. I think they're going to be really good markets, and they are. Um, I would have, I would have stuck to my guns a little bit more on those, and I would have gone after those areas a lot harder than we have.
Mm-hmm.
And um, you're talking about Brandon. One of the nice things Brandon has is he has a solid, steady market that's supply constrained, and
Yeah.
and these two markets I'm talking about. Sorry guys, I'm not giving them away because I'm looking hard in both of them right now. Uh, I I would these are supply constrained markets with heavy demand. Um, and they're growing. But most people outside of the Carolinas, even there's a lot of people in the Carolinas that don't even look at these markets. They look
Mm-hmm.
at the major metros, or they're like Charlotte and Raleigh are overpriced, so I'm going to Greensboro, right?
Mm-hmm.
Um, and nothing against Greensboro, not really my cup of tea. Don't love it for a couple of reasons. And so because of that, we look at a couple of these other markets like I'm thinking of here. And um, I would have taken the Brandon approach, and I would have gone after those two, like all in,
Yeah.
absolutely all in. I would
Yeah,
probably
that
own,
makes a lot of sense.
I would probably own 4 or 5 things in both those markets right now if I had
Yeah.
done that. Um,
Right. Right. Yeah, that makes a lot of sense. Hmm.
um,
Interesting.
yeah, but you're not wrong, right? I mean, the spread can become difficult for sure. Um, and then where it really becomes kind of a headache is when you're trying to source talent that's willing to like perform in those markets.
Yeah.
Um so um yeah, it gets interesting. I looked the other day, man. We have you're speaking of that kind of thing. We have an employee who is an awesome employee, um but in the last this year we've paid over 8,000 in mileage to this employee.
I believe it.
Yeah.
Yeah, we spend a lot of money on mileage for a couple people, and they're worth it. That's exactly where I was going to go with that. Was it can be difficult to find resources within the
Yeah.
market. So what we've had to do is bring more resources from out of the market and spend a ton of money on mileage to get the person there.
Yeah.
Pros and cons, though, right? I mean, It's not easy no matter which way you cut and dice it, but it's definitely a problem that you have to solve. But that, to be fair, Tim, I mean, that's also part of the reason why we had the opportunity, because it was difficult and we were able to solve that
We were
problem
able to solve it.
operationally. Yeah, I mean, that was
Yeah.
part of the reason why the guys that sold it to us sold it, is because they were struggling with the operations side of things. And I'm
Right.
not saying that it's a cakewalk for us either, but at the end of the day, we were able to solve one of the largest issues was the staffing.
Yeah. Yeah. And guys, like another way to think about that too is like we're talking about mileage, right? But I bet you if you sit down, and I'm only going to say this because I have, um, if you sit down and look at it, you'll realize like, okay, if I had hired this person in the market where this property is, rather than pay somebody an hour and 15 minutes away to drive in, my salary would have been somewhere between ten to $12,000 more per year.
Right. And
Right.
you're going to spend it on
So
mileage anyways.
yeah. And well, I could have had the person here, but I would have paid more in salary. Well, I'm paying mileage, and instead of someone directly in this market, now I've got somebody kind of at a centralized location working 3 properties, right?
Mm-hmm.
So, like you said, it's like a give and take, and I think overall we're probably still coming out ahead, but it's still tough to it's a tough problem to solve. You got to find the like right person
Yeah.
that's willing to do that drive, take the mileage, and still perform.
Yeah.
Because we've certainly found employees who will do the drive, take the
Yeah.
mileage, yeah, but their performance kind of sucks.
Right.
Yeah.
Right.
So,
Right.
um, but yeah, I mean, at the end of the day, I think that's probably to your question is hindsight being what it is. Yeah, I would have picked some secondary markets within proximity that are still growing with some pretty good supply. I mean, supply constraints, and that's where I would have focused.
Mm-hmm. Yeah.
So
Yeah. Interesting take.
yeah.
Dennis, to answer your question, would you have the same investors if you didn't go out farther? We actually took a lot of the investors from the Carolinas and kind of showed them this market and said, well, this is why we think you should also invest here. And we're doing okay in some of those markets. But to answer your question, we would have the same investors. So it didn't really make an impact on us. We didn't gain investors by being in this new market ultimately.
Yeah. 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 I think that's, a key take there, man, is people say it, and I find it to be very true. And investors tend to invest in people more than deals.
Right.
And I would agree with that. I think most of our investors invested because of us,
Mm-hmm.
in the
Yeah,
belief
for
in
sure.
us rather than the deal specific. No, I'm sure there's outliers to that, but um, you know,
Yeah, agreed.
because listen, man, I get I'll tell you right now, I get texts every day from a particular investor, and his returns look amazing. His returns look amazing, but I'm not investing with him.
Yeah.
And it's not because of the deal. So
Principles matter.
yes, they do.
Yeah.
But so hopefully, Dennis, that answers your question. I'm not sure we did, but
No.
um, I don't know, man.
Uh, Dennis, do you have any questions maybe about, from our perspective about what we would do differently, or why we think it's better off to start out now than before?
While we're waiting for that to come in,
Yeah.
one other thing. So not only has seller expectations changed a little, not fast enough, like we talked about. I think interest rates also have people more realistic now too. I think we've
Mm-hmm.
all kind of come to realize like, hey, we're never going back to the 2 and 3% interest rate days. I won't say never, but I doubt I see it in my lifetime. So I think people are starting to get more realistic with like, hey, 5, 6, 7% interest.
Is sustainable.
That's sustainable. I can probably, if I got a deal that operates there, I can probably live there for a while, and I can probably expect to have access to that when I go to
Mm-hmm.
refi.
Yeah.
Because there's a lot of people buying in 22. I mean, I specifically, I'm sitting, like, it's just popped in my head. I specifically remember having a conversation with someone who I have a lot of respect for, and they were like, "Man, I think interest rates keep going down," and we were at like 3.5% at the time, and
Mm.
and he was convinced interest rates were going to be 2.5%, somewhere in there, and I mean, we're not, we're not,
Yeah.
and
I
and if
think this whole experience has really taught me a lot about kind of the macroeconomics that affect interest rates because there's been such a highlight, there's been such a spotlight on
right,
the jobs reports, right, and the Fed meetings and the treasuries and inflation numbers and CPI and all of those. Like I was aware of them, but I didn't fully understand how they worked or why they were important. And this whole experience with rates rising since 2022, like I think it was June 2022 when everything started going off the rails. Um, it's really brought another level of experience and thought process, I'll say,
yeah,
when analyzing the information and predicting where do we think rates are going to go, what do we think they're going to do in the near term, the short term, long term. Just help kind of broaden the horizon of vision, right?
yeah,
Of forward projecting, and truly understanding what's going into those numbers and that data, and having good reasoning behind why I think the numbers are what they are.
yeah,
The one thing that you can never predict, though, is if there's another black swan COVID event, right, where
right.
where the whole world shuts down and they have to drop interest rates to zero overnight in order to keep the economy afloat.
Yeah, yeah, and I agree with you on that. This whole period. I mean, that's the cool thing about this, right? No matter how long you do this, there's something to learn,
Mm,
and I do agree. I think there is a whole lot going on right now that if you're paying attention to how interest rates work and what drives them and how they
yeah.
react, um,
Hmm.
you start to see, hey, it doesn't. It's not really tied to when Powell comes out and says he's raising or lowering, right? I mean, that's a factor, but it's
Right.
not the factor. And and I think you can, if you're really paying attention right now, I think you can get a lot smarter moving forward about, like, hey, just because he says this doesn't mean this is going to happen, right?
Right. Correct.
Um, so and you start to pay attention to, like, those five other canaries, right,
Right.
that are in the mine with you.
Yeah. That's a good way to say it. The canaries. I like that.
Yeah,
So Dennis said, if you had to start over now, do you think that's the niche you would be in, light tech affordable housing? I think yes. I just think it's an underserved market. I mean, I really still think that we don't have a lot of competition in the market. Um, the biggest problem with affordable housing and light tech is being able to operate it efficiently. So
hmm,
we built our entire company around light tech. Like, one of the prerequisites to work at our company is you have to have light tech experience in some way, shape, or form, even if it's for 6 months, a year, 2 years, so that there's not this like infinite learning curve of understanding light tech or affordable housing. Now, we send our employees out to training. They do compliance 101. It's all part of our employee onboarding, which is super important. But I think that I would still stay in this niche as much as I want to bang my head against the wall some days. About like all the complexities that we have with the affordable housing. Just I think the benefits outweigh the negatives in the grand scheme of things, with debt treatment, with tax abatement ability, with
yeah,
with limited competition and expanded cap rates. I just think that everything lines up better, long term for affordable housing, and especially going forward. I mean, it's been the hot topic for presidential debates and elections forever. So it's just I don't see it going away, and I think that if you can specialize in a niche like that, then
yeah,
you'd be able to be successful. Really.
yeah. And I agree with you. Because like, we'll talk about the Charlotte market for a second. Like, I look around me at everything that's going in the Charlotte market, and I will tell you this: rents Rents are softening a little bit right now, but at the end of the day, they're still very high. They're not affordable for most people in the Charlotte market. And when I see all the construction going on around me, you know what they're not building?
Affordable housing.
Affordable housing.
And
It's
you know what I
all
like to see, Tim? I mean, I
yeah,
can think of one property in the Charlotte area that we bought. When we bought it, the rents were, I don't know, 600, 700, and the
yeah,
voucher rates were like 1,200, twelve
right,
fifty. And in 2 years, they went from 1,200, 1,250 to 1,325 or 1,300. And now the new rate for 2025 was 1,465.
yeah,
And it's astronomical. Like when you say rents are softening, that's not true in the affordable space, right? Because
right,
they're lagging on the information that's comparing to their
right,
affordability. So you're always on a 2 year lag of where your rates need to be. So if you're able to buy it with low income and sit on it, you're going to get, large increases. And we're seeing that. We're getting renewals. I think one of our property managers had 6 renewals at 1465
right.
on a voucher, which is
Yeah,
insane.
yeah. And guys, like, I mean, we're seeing that across the board, and a lot of that's driven by like the other things going on in the market that
Mm-hmm.
you know all this luxury housing, it raises the average, right? So,
That too.
right. So, I mean, that's part of what we're benefiting from in that regard, without having to go out and try to lease things at 2,500 for a 2 bedroom
Yeah.
unit.
I
Um,
mean, we essentially we don't have advertising budgets for our affordable properties because we don't have to
mm-mm.
advertise to get traffic and deal flow,
Yeah,
guest cards, right?
yeah,
So that's a huge expense that we don't have to invest into.
yep.
So
Agreed. So,
yeah.
all
All
right,
right,
guys.
guys. Well, thanks again for joining this week. Appreciate the question, Dennis. Hopefully that provided a little insight for you. Always appreciative that you joined every single week. You're number one fan. Love you, man. All right.
See you,
See you guys
Dennis.
next week.
All right, bye, guys.
Peace.